Hello everyone, my name is Blaine Pearson and I am an instructor in Texas Tech's Personal Financial Planning program. In this video, we're going to take a look at an overview of the Capital Asset Pricing Model, or CAPM. To begin, let's jump right into what CAPM is. So, we're trying to solve for the expected, noted by the E, required rate of return an investor requires. So that equals the risk-free rate plus beta of the market times the risk premium. The risk premium is found by subtracting the return of the market minus the return of the risk-free rate. You may also see the capital asset pricing model expressed this way, where KE is the cost of equity, which equals the risk-free rate plus the market risk premium times the beta. A few bullet points to note: the expected return must be higher for riskier assets. We would expect to achieve a greater return by investing in more risky assets. This is noted by when we lever our market premium by the beta coefficient. And as we learned from other prior videos, the beta coefficient is just the measure of systemic risk. The market premium, of course, as we reviewed, is the price demanded for the risk taken on, which is just the return of the market minus the return of the risk-free rate. There are a few assumptions that we need to make for capital asset pricing model to work. The first one is that we must assume that all investors are risk adverse by nature. The second one is we must assume that investors have the same time period to evaluate information. The third one is we must assume that there is unlimited capital to borrow at the risk-free rate. The fourth one is that investments can be divided into unlimited pieces and sizes. And lastly, there are no taxes, inflations, or transaction costs. So while this may seem like CAPM is theoretical, the intuition and the concepts are still very relevant. Going back to that assumption, we can see the expected return given the levered risk premium. So it predicts our expected rate of return on an asset based on how risky that is by the levered risk premium. Again, as we reviewed, beta is what we lever the risk premium by to get that market risk premium. Let's work an example of CAPM. We'll need to make a few assumptions. Let's assume that the risk-free rate is the treasury bill that yields 0.2%. Let's assume that the average return on a stock is about 8%. So the expected return with a beta of 1 is simply 0.2 plus 1 times the difference between the return of the stock minus the risk-free rate, which equals 8%. The higher the beta, the higher the expected return. We can see how this is evidence. This is from Fama French's paper. All the CAPM predicts is the SML line, the security market line. For example, if our risk-free rate is 7%, that then becomes our intercept point. So CAPM is more or less just a simple linear regression of all the potential stocks that are available. Again, this is Blaine Pearson, and in this video, we covered an overview of the Capital Asset Pricing Model, or CAPM. Thank you for watching.